Sanctions tighten. Tariffs bite. Headlines scream. And yet, India's Russian oil purchases haven't stopped. They've just gotten smarter. Tonight, we map the routes, decode the middlemen, and show how this quiet oil math shapes your gas bill and global politics. Quick picture. After 2022, India rapidly scaled up purchases of discounted Russian crude. Cheap barrels feed massive Indian refineries, which then export fuel worldwide. The result? Fewer price spikes for Indian consumers, stronger margins for refiners, and a new headache for Washington's sanction strategy. Here's the twist. It's not a blanket ban. The US and G7 designed a price cap. If Russian oil sells above a set price, Western shipping, insurance, and financing can't touch it. That turns the pipes, tankers, insurers, banks into the real choke points. If you can move oil without those services or blur the paperwork, you can keep the barrels moving. Enter the mega contracts. Russia's state producer strikes long-term supply deals with major Indian refiners. Big volumes mean better terms and predictable flows. For India, that's energy security and lower input costs. For Washington, it's a moving target. Legal if within caps and rules. Controversial if it skirts them. Not every barrel moves direct. Intermediary traders, often based in the UAE, aggregate cargoes, arrange shipping, and use dirhams or yuan to sidestep dollar friction. When banks grow cautious, payments reroute. Result: fewer obvious fingerprints, smoother flows. Meet the shadow fleet. Older tankers with opaque ownership, sparse insurance data, and creative routing. Many cargoes transfer ship to ship, get blended or relabeled. The goal isn't cinematic, it's bureaucratic. Complicate origin, muddle price, and dodge restricted services. Why persist? Because it prints margin. Discounted crude goes into complex refineries. Out comes gasoline, diesel, and petrochemicals sold across Asia, Africa, and sometimes back into Western markets as refined products. The spread between cheap feedstock and market price fuel can be huge. Washington's objective: limit Kremlin revenue. Tools: tariffs to raise pressure on trade partners, tougher sanctions enforcement on shippers and insurers, and steady audits of transactions that look above cap. Each turn of the screw raises costs and legal risk, without triggering a global price spike. That's the tightrope. Four pressure points could change the game. 1. Harder enforcement. Secondary sanctions on buyers or service providers. 2. Maritime choke points. Fewer permissive STS zones. More detentions. 3. Payment squeeze. Banks and FX rails freeze. Settlements fail. 4. Shrinking discounts. less incentive for India to load Russian barrels. Strategically, India practices multi-alignment. It buys where the math works, signs long-term deals to hedge supply, and keeps options open. As long as enforcement is uneven and discounts persist, the energy math often beats the political heat. That frustrates Washington, but it's a rational play for a fast-growing economy. Strategically, India practices multi-alignment. It buys where the math works, signs long-term deals to hedge supply, and keeps options open. As long as enforcement is uneven and discounts persist, the energy math often beats the political heat. That frustrates Washington, but it's a rational play for a fast-growing economy. If you want clear breakdowns of sanctions, tankers, and your wallet, subscribe to Money Traps. Question of the day: will tougher enforcement curb these flows, or push them deeper into the shadows? Drop your take below.